A very good day to all our directors, whom are present currently. Our team consists of Eka, Nana, Raymond, Nicholas and Jackson, had conducted an analysis of a company which we, as a team, would consider as a potential company to be invested in. Now, let us move on to our next slide, which we will be describing briefly on this particular company called APM. A brief introduction towards this company. It is established in the year 1978 and had an official opening in the year 1980. By now the ex-Prime Minister of Malaysia Dr. Mahathir. APM Automotive Holdings had established their headquarters in Port Klang, Malaysia, and also a Malaysia-based investment holding company. This company operates in 6 different divisions. First is the suspension division, which manufactured and supply suspension in automobile. Second is the interior division, which focus on the internal parts of the automobile. Plastic division is the company third division, which are responsible for supplying plastic parts in general. Fourth is the electrical division, which generally involve with electrical appliances in the automobile. Then, the fifth division is the heat exchange division. Follow on with the sixth and final division will be their marketing division. APM also had won numerous awards throughout the day they were established until presently. Moving on to the core business of the company, as was mentioned above, based on the 6 different divisions, the company is manufacturing parts such as leaf springs, shock absorbers, metal parts and so on. They also manufacture seatings as well, for motor vehicles, buses, auditorium and cinemas. Also the air conditioning systems, radiators, starter motors and other electrical parts. APM also had some side business, which is the engagement in the rental of investment properties. Not only that, the company also had provision of automotive research and development service. Next, we shall explain the choices that we made and fixed our eyes on this company. Due to a huge sum amount of up to 2.5 million entrusted, therefore it is crucial for us not to make any mistake in investing in this company, which can prevent time and money wasted. Here, we use 5 main ratio, with each ratio to have a sub-ratio in it. The 5 main ratio, as you can see, are liquidity ratio, activity ratio, debt ratio, profitability ratio, and market ratio. Within each of these 5 main ratio, there is current ratio, quick ratio, total asset turnover, inventory turnover, average collection period, average age of inventory, debt to asset ratio, net profit margin, operating profit margin, return on assets, return on equity, earnings per share, gross profit margin, price to earning ratio, price to book ratio. First we will look into the first main ratio, which is liquidity ratio, which consists of current and quick ratio in it. So based the annual report of APM on the year 2011 to the year 2013, the figures on the following tables were obtained. As we can see, APM current ratio increased from 2011 to 2012, which is 3.98 to 4.01, and experiencing a decrease in 2013, which is 3.4. The increase on current ratio from 2011 to 2012 is showing an advantage in short-term financial aspect. For the quick ratio, APM increased in 2011 to 2012 from 3.17 to 3.19. However, they experienced a huge decrease to 2.56, which is due to the huge increase in current liability. This could be a result from increase in financial loans. The similar case in quick ratio, which dropped conjunctionally as well in 2013, is due to the massive purchase in inventory and increase in liability. Next, we look into the second main ratio, activity ratio. As the table suggested, the total asset turnover in APM decreased from 2011 to 2013, which is from 1.11 to 1.05 to 1.03. This shows that APM is not efficient in controlling assets to generate sales. In contrast, APM is increasing the rate of inventory turnover from 5.38 to 5.61 to 5 in 2011 to 2013. For the average collection period, APM is actively collecting debts from their debtors. This is shown by the increased figures of 65.16 to 69.8 in 2011 and 2012 and dramatically increased to 80.5 in 2013. Interrelating to inventory turnover, the average age of inventory in APM is good because the figure decreases from 67.84 to 65.01 in 2011 to 2012. However, in the year of 2013 the figure increased massively to 73, which shows that APM is facing a challenge in their selling business. Following on, we look into debt ratio. The debt-assets ratio is more or less constant with the average of 0.2 from 2011 to 2013. If to be looked into more specific in detail, the difference are by 0.02 the most. In percentage, we can see that APM had their assets to be financed by debts on 20%, so there are not much significant changes occurred. Moving into profitability ratio, the net profit margin of APM decreased from 2011 to 2012 and increases back in 2013, which is 10% to 9.40%, then towards 9.80%. The company's unacceptable progress in making profit. The operating profit margin decreased from 2011 to 2012 and remained constant on 2013, which is 14% to 13%. The decrease from 2011 to 2012 shows that the company is suffering a declination of 1%. For the return on assets, the figure decreased from 2011 to 2012, 11% to 9.90% and increased back on 2013 to 10%. It shows that APM is able to retain back their common stockholders' earning for every $1 invested. The same scenario present in return on equity, which decreased from 2011 to 2012 and increased back in 2013 with the figures 14.50%, 12.80% and 14% respectively. For earnings per share for APM is decreasing from 2011 to 2012 with the amount of 60% to 56% and increased to 61% in 2013, which is the best performance among the 3 years. In gross profit margin, the figure decreased from 23% to 20% and increased back to 21% throughout the years. Overall, the profitability ratios is showing the same pattern in the annualized ratios, which means that APM is progressing well considering they're retaining back their productivity level. Lastly, we focus our attention towards market ratio, or price ratio. The APM price-to-earning ratios increased from 9.22 to 9.72 in 2011 to 2012. However, the figures decreased back. 8.93 in 2013 shows that investors are pulling back their confidence for their final year. Price-to-book ratio decreased from 1.38 to 1.28 and 1.24, which means the company assets value compared to the market price is getting lower. Finally, we come to the end of the conclusion. Based on the annual report of the APM company, our findings on the financial analysis ratios were showing a positive majority in business. Out of all debt-to-asset ratios, net profit margin, operating profit margin, earnings per share, gross profit margin, ROE and ROE were in a good position. Despite some of the decrease in figures that APM was having, they were still exceptionally considered to have an average performance. This is because of the unavoidable recession that took place in 2012. Judging from that, APM had recovered well the following year with increasing most of their productivity in the automobile service industry and regaining trust from stakeholders. For that, we decided to invest in this company because we believe in the potentials of APM. And thus ends our presentation. We hope to hear your final decision to invest or not to invest in APM. We would like to thank you for attending once more. We are also really appreciating thank you for your time.